Any occupation coverage can be less expensive, but it can also be less predictable at claim time, because the claims analysis can expand into vocational assessments, transferable skills evaluations, labor market surveys, and arguments about alternative work that you may not view as realistic. Now consider own occupation. An own occupation definition generally means you are considered disabled if you cannot perform the material and substantial duties of your regular occupation, even if you are able to work in another occupation. In the strongest form of own occupation, sometimes called true own occupation, you can potentially receive full disability benefits while earning income in a different job. That difference matters most for specialized professionals and high-income roles where the value of your work is tightly connected to specific skills, physical capacity, or cognitive performance. Think surgeons, dentists, anesthesiologists, trial attorneys, pilots, interventional radiologists, and certain technical sales or executive roles where the job is not easily substituted by another role at similar pay. However, not all own occupation language is equal. Many policies use variations such as modified own occupation or transitional definitions, and some policies define your regular occupation in a way that depends on what you were doing immediately prior to disability, or what you were trained to do, or what you were doing for the majority of your time. Details like these can produce very different outcomes in close cases. A clean way to think about it is this: any occupation asks, can you work somewhere? Own occupation asks, can you work in your occupation? And writers then fine-tune how that question is answered, how benefits are calculated, and how the policy keeps up as your income and costs change over time. Now let us talk about the riders that can change the price, because riders can add meaningful value, but they can also make a policy significantly more expensive, and sometimes a rider that looks helpful is not worth the premium for a given profile. First and often most important is the residual disability rider, sometimes called partial disability. This rider pays a partial benefit if you are not totally disabled, but you have a measurable loss of income due to sickness or injury. Without this rider, many policies only pay when you meet the definition of total disability, which can create a harsh cliff. Either you qualify fully or you get nothing. Residual coverage smooths that cliff. Residual benefits are especially valuable because many real-world disabilities are partial. A back injury that limits procedures, a neurologic issue that reduces hours, a chronic condition that forces you to stop on call or a mental health episode that reduces capacity. Residual riders typically use an income loss test, sometimes combined with a time or two loss test, and the exact formula can vary. Some riders are more generous in the early months. Some require ongoing proof of income loss. Some include recovery benefits after you return to work. Residual coverage often increases premium meaningfully, but it is one of the riders most closely tied to claim frequency and real outcomes. For many buyers, it is closer to essential than optional. Second is a cost of living adjustment rider, often called COLA. This increases your monthly benefit over time while you are on claim, typically tied to an index or a fixed annual increase. The purpose is to protect purchasing power during long claims, which can last many years for severe conditions. COLA can be very valuable for younger inserts with long benefit periods, especially if your benefit is intended to cover core living expenses that will inflate over time, but COLA can be less cost-effective for shorter benefit periods or for people who expect significant assets or other inflation hedges. COLA also comes in different designs, some compound, some simple, some cap annual increases, and the premium impact can vary accordingly. Third is the future increase option rider, sometimes called a future purchase option, benefit update, or guarantee. Insurability. This allows you to increase your coverage later as your income rises, typically without new medical underwriting. You may still need to show financial justification, but you can avoid the risk that a new health condition blocks you from increasing coverage. This rider can be particularly valuable early in a career, for residents, fellows, early attending physicians, new attorneys, and entrepreneurs who expect income growth. It can also be useful if you are buying conservatively today, but want the flexibility to increase later. The price impact depends on the structure. Some riders charge a premium now for the right to buy more later. Others embed a smaller charge, and then the added coverage is priced at your attained age when you exercise the option. The details matter, especially around how much you can buy, how often, and whether the rider automatically offers increases or requires you to request them on specific anniversaries. Fourth is the catastrophic disability rider. This pays an additional benefit if you meet a stricter definition of catastrophic impairment, such as inability to perform a number of activities of daily living, severe cognitive impairment, or presumptive loss situations. Catastrophic riders can be expensive because they add meaningful benefit in high-severity claims. They can be more relevant for buyers who want extra protection for worst-case scenarios, especially if their base policy benefit is capped below their true earnings. Fifth is the retirement protection rider, sometimes called a retirement benefit. This directs an additional amount into a retirement account or a notional benefit while you are disabled. The idea is that disability can interrupt not only current income, but also long-term savings. These riders can be valuable, but they can also be costly, and they can overlap with your own savings strategy. If you already have substantial retirement contributions and flexibility, you may prioritize other riders first. Sixth is a student loan rider for those with significant education debt. This adds an extra benefit specifically to cover qualifying student loan payments during disability. It can be attractive for certain professional tracks where debt is large relative to early career income, but you should look closely at eligibility rules, waiting periods, offsets, and whether the additional benefit is payable under total disability only or also under residual disability. Seventh is a mental nervous limitation rider topic. This is usually not an add-on rider you choose. It is often a limitation that already exists in the base contract. Many policies limit benefits for claims due to mental health or substance-related conditions to a shorter period, such as 24 months, while physical claims may be payable to age 65 or longer. Understanding these limitations is critical, and in some markets or with some carriers you may be able to buy back or improve this limitation. If available, that improvement can increase premium. Eighth is the elimination period and how riders interact with it. The elimination period is the time you must be disabled before benefits begin. Common choices include 90 days and 108 days. A longer elimination period generally reduces premium, but increases the amount of risk you retain. Some residual